everybody. This is Colin podcasting about real estate, and welcome to show 6. Today's guest is Lee Kearney, one of the nation's most successful single-family real estate investors. Incredibly, Lee has bought and sold more than 7,000 properties in the past 16 years, and he owns multiple businesses throughout the country. It's a very high caliber guest. I'm delighted he came to the show. But before we get to that, I want to remind our listeners about a couple of things. First, I published a new website recently called colininvestments.com. It's my way of providing some tools and resources to help people accelerate their real estate journeys. You'll find a range of videos, podcasts, and market reports that are completely free to access. That's colininvestments.com. Second, you can find me on social media, on Facebook and Twitter via Colin Investments, and on Instagram and YouTube via Colin G. Murphy. And third, if you're enjoying this show, please take a moment to give it a quick review and or rating. I'd really appreciate it. I am trying to get the word out. So getting back to today's show, and it's a really good one. I've met Lee several times over the years, and I've always been impressed at how he built and scaled an incredibly profitable real estate business in an industry dominated by mom and pop firms. Lee's also a very down-to-earth guy who spends a lot of his time helping others. And as you might expect from a guest of this caliber, he had some fascinating market insights to share with us today, including the hard lessons he learned during the 2008 crash, why he sold 95% of his personal portfolio in the last 18 months, why real estate prices have been increasing during the last 4 or 5 months, why Lee thinks there could be twice as many foreclosures in 2021 and 2022 compared to 2008 and 9. We'll also talk about the best activities and deal types for investors during the next 18 months. We talk about the skills needed to be a rehabber and a wholesaler. We also talk about the importance of mentors and how to find them, and much, much more. So I think you're going to enjoy it, and let's head over and chat to Lee. Lee, how you doing, man? Welcome to the show. It's good to see you.
Thanks for having me.
No, my pleasure, man. So listen, for the people that don't know much about you, a lot of people in Tampa and beyond will, but can you introduce yourself briefly and tell us how you got started in real estate?
Sure. Yeah, my name's Lee Kearney, CEO of Spin Companies, which is all of the real estate companies I own. We buy and sell properties, we wholesale them, we rehab, we buy notes, we sell notes, we borrow money, we lend money. So we do lots of things in real estate, over 7,000 transactions, over $500 million at this point. I'm also CEO of Real Advisors, which is the real estate education arm where we teach people how to do real estate, all the way from newbies to experienced operators, commercial. And that's really the 3 things we focus on there. And I'm also the owner of FAST, a co-owner of FAST with my business partner, Ken. And we own 2 startups in Oklahoma in the cannabis space. And we're going to be moving into several other states. And that's probably one of the more exciting things I do, because that's being able to use the money I've made in real estate, parlay that into cannabis. It's been exciting, but I attribute all my success back to real estate, because that's where I generated the money. And that's really probably one of the things we're going to talk about. Real estate's a great place to generate cash. It's not the be all and end all, but it's a great place to generate cash.
It is. And you've been doing it since 2003, 2004, something like that?
Yeah, 2003 was my first accidental flip. And then 2004, I did it for real, did 2 flips in 2004, did several deals in 2005, and then 2006, really put my foot on the gas, but it was at the wrong time. So I ended up at 2007, $2 million upside down after being $2 million up. It was something, I'm not sure about you, Colin, but I hadn't experienced just such a crash like that ever, where it just went up and went down overnight. I couldn't understand how I had 70% loans that were now, this was the worst one I got, by the way. I'll give you this deal just to highlight how bad it was in 2008. Bought the deal for $140,000. No, $100,000 I paid for it. It appraised at $140,000. I took out a loan for $70,000. You with me so far? That sounds
50% loan. Yeah,
pretty decent, right? Right, exactly. I short sold that condo 2 years later for less than $25,000. I mean, just took a bath on it. Just absolutely took a bath. The values just went through the floor. I remember in 2009 and 2010 buying properties I'd sold in 2007 for 25 grand, where I'd sold them for 150, 175,000. I mean, it was just an amazing drop in prices. And, people say, oh, that'll never happen again. Along comes COVID. And I'm sure we'll get into that in a few minutes, but yeah, I'm definitely I have one eye open with this particular market that we're seeing right now. Even after doing a lot of deals, sold most of my rentals over the last 2 years because we're at peak pricing. If you look at any graph, you go to Tampa Market, Zillow, just look at the last 10 years, you'll see it's come up, and it's all the graphs. You do Tampa, you do Atlanta, you do Miami, you do Vegas, doesn't matter. You San Jose, I did that on the podcast last week. And what's interesting about San Jose, it took the dip a year and a half ago. People don't realize that San Jose started going the other way literally a year and a half ago. So
It is.
it's coming.
So you've sold a lot of your personal rental portfolio, and how big was it, and how many have you sold in the last couple of years? Are you still holding on to
doors,
that?
Over 300 doors, and 95% of it's gone.
Wow, so you've sold 95% of your personal rental portfolio that you've been building up over the last, 10 years, presumably 8 years.
Yes.
And there's a lot of experienced people in the market that might have 9 years experience in real estate, but the market's only gone one way. So for people that have been around a little bit longer, I mean, can you tell us a little bit about some hard lessons you learned in 2008 and what strategies you put in place to avoid getting caught out in a dramatic market shift again?
Sure. I think I'll phrase it with a couple quotes from my mentors. The first one is, there's always money in real estate. You just got to be on the right side of the trade. And the best example I could give you is that I was at the courthouse scooping up the house for 25 grand that the buyer owed 170,000. The exact same transaction. One person's losing and one person's winning. So obviously they bought at the wrong time. I'm taking the exact same house, but I'm buying it at the right time. So that's the thing about real estate. It's a cruel mistress. Once you get your timing right, you can always make money. But it's not always the right time to buy and hold. It's not always the right time to, actually, it's always the right time to wholesale, by the way, because you'll never lose. But it's more optimal at the bottom of the market to buy and hold, because then you can ride that property up, get the appreciation, the rent appreciation, all the good stuff, along with the tax write-offs. But flipping, where the biggest mistake I went wrong was I was rehabbing into a downward market between 06 and 07. That was my single biggest mistake. And my second mistake, on top of rehabbing into a downward market, which sounds silly, but that's what I was doing, was buying and holding and cashing out and having non-cash flowing rentals. So what happened was the flips I couldn't sell, I said, I'll keep them as a rental because the money was flowing. And sure enough, I said, it's only $100 a month, right? I'll write it out. How long do you think before losing $100 a month and you have one major repair, you're going to want to keep that house? So that got real old after about a year of losing money consistently on every single rental. And it added up. You start to get repairs on top of a negative cash flowing rental. I couldn't sustain that because it was just cash out. There was no cash coming in. So my two biggest mistakes, rehabbing a downward market, non-cash flowing rentals.
And just so people know, rehabbing in a downward market basically means working your ass off to lose money when you sell a house, which is no fun whatsoever.
It was terrible. But I mean, if you talk about being on the right side of the trade, the wholesaler that sold me the property made money. Again, exact same transaction, just like the buyer losing the property foreclosure auction and me buying it, which is when I got smart in 08, 09. But the same transaction where I bought it from the wholesaler and they'd make a $10,000 assignment fee, I was rehabbing it, losing money. So I've seen this example over and over again. I remember one of my mentors bought $100 million worth of first mortgages in 2008 during the global collapse when the stock market, hit 6,000 on the Dow. And I said, how much did you buy $100 million worth of first mortgages for? How much do you think you bought them for?
In 2008? Oh my goodness. 20 million?
10.
30? 10.
Flipped in the same week for 20. So you think about the craziness. The bank just took a $90 million bath and he made $10 million. Exact same trade. He was the buyer and they were the seller. I could spend the next, rest of our show going on to examples in real estate where it's not about the deal, it's what side of the deal you're on. So that's always stuck with me. And I've really impressed upon everybody to pay attention to that lesson. If you're buying and acquiring a rental portfolio at the peak of the market, what are you doing? Why on earth would you do that? Why, when you see the rapid appreciation over the last, I'll say really last 8 years, because the market really took off. Most primary markets, now that we have history behind us, took off in 2011 or 2012, because that's when the big institutional money came along. And right now, even if you're not buying at the peak, you're sure buying a heck of a lot higher than you could have bought 8 years ago. So there's going to more than likely be a big shift in pricing in stuff where there's going to be high default rates, which is probably a conversation we need to have now, because that's a story that's not being told.
Well, let me ask you that then, because it's confusing me. So we've got high unemployment, we've had a lockdown, we've got huge volatility in the stock markets, but residential real estate prices, and especially single family homes, have been super resilient, just increasing in prices. And I bought a lot of property in parts of Tampa that have increased by up to 10% just this year alone. And it's super tight supply, super low interest rates, big wall of government money propping all the asset prices up. But what's next? What's going to happen in the next quarter? In the next quarter, where do you see this line? Because it's very I feel like a driver driving in the fog. I don't know what's in front of me really at the moment.
Well, I think you've answered your own question there. The lack of supply and low interest rates are what's fueling it. You got buyers scared or sellers scared to put their property in the market because they don't want to move. You got interest rates through the floor, and then you've got banks not foreclosing on people. So that again is restricting supply. The normal supply of foreclosures, gone. Normal sellers that normally sell during selling season, not selling. So that leaves you with a really low supply, really low interest rates, and that's what's fueling the market. But what follows? Right now, there's people not paying their mortgages. So the delinquencies, depending on who you ask, and again, I'll probably get people saying, "Oh, you're wrong." About a quarter of borrowers are not paying their mortgage in some shape or fashion. That seems to be what a lot of the statistics are showing. We won't have the true number until they're actually defaulted, and that becomes public record. And then beyond that, in the foreclosure state like Florida, they've got to file the lis pendens. So when you say what's happening, probably not third quarter, maybe not even fourth quarter, but definitely first, second quarter next year, forbearances are gone. The banks are going to turn delinquencies into defaults. That's going to turn into a lis pendens in Florida, and you're going to start to see those rates come up. So I'm quietly confident that the beginning of that inventory is going to start, and we're going to really see a shift in the market. So that's going to cause an excess supply, even at the lis pendens stage, when the foreclosure is filing, when the borrower said, "Oh, I've got a decision to make. Now the big fees are starting. My equity is going to go away overnight. I probably need to sell my property or just lose it." And so things are going to change. We're in a false sense of security. And a big part of it is that the banks are not moving on getting people out. But conversely, landlords are not being able to get people out, which means they're not able to pay on investment properties. So this is really the same thing for commercials, the same thing for residential landlords, same thing for tenants, it's the same thing for homeowners. Everybody's not paying. So what's going to happen is that's going to dramatically affect real estate prices, because that inventory is going to work its way through the system. Now, there's some people that once they get back on their feet are going to pay, but a lot of people are used to this 4 month, now 5 month free ride. And they're not going to be paying again. They're just not. And so I think, and this may sound crazy, based on what I'm seeing with what's happened with COVID, although we're going through a normal market cycle, we may see more than double the delinquencies or the foreclosures we saw in 2008. I really believe that. And I'm saying twice as a low number. It's so dramatic what's happened this year, because it's affected every sector of real estate. Think about people working from home. Preferences completely changed. I talked to a friend yesterday. The dry cleaners are closing. Why? People aren't going to work. People aren't dressing up. And that might sound like really like...
It's funny, they're one of the few businesses allowed to open in the lockdown, but
think about it. If everyone's in their shorts and t-shirt like I am right now, why on earth would you need to get stuff dry cleaned? You don't. And so across the board, preferences are changing. You look at Amazon, they're over 3,000 at the time of this recording. Then you look at the airlines and you look at the cruise lines, they're in the toilet, because what's happened, this has shifted. The transfer of wealth has already happened in this country. Now, it hasn't happened across the board, but in industries, some industries are on fire and other ones are just gone forever. Like you talk about WeWork and these places where office share, people aren't even going to office. The people that were teetering on going to an office are definitely not going to an office now. So that business is probably toast. And then you look at a lot of people building commercial real estate and trying to rent out office space. Even here in my own office, I was getting $2,000 6 months ago for about half my office. Now I can barely get $1,000. So I'm seeing this firsthand, that there's a big shift already in the market. But in residential real estate, we won't see it until the bank puts the hammer down, starts moving that inventory through the system. And unfortunately, that's painfully slow. Last cycle,
Yeah.
it took them about 3 years to get through that glut of inventory.
So it
Literally
sounds like
3 years.
there's going to be a little bit like there's almost a dam, and it's they're just trickling out. Inventory is tighter than it normally would be, if there wasn't the pandemics, which is making prices maybe slightly higher than they would be. But you're saying that's false. That's a false economy. The reality is that prices are going to fall because of all the underlying factors, because if we're at the top of a cycle anyway. I mean, is it so? I mean, if that's the case, that prices could fall dramatically, let's say in a year's time, and it might take 2 or 3 years before it bottoms out again. I mean, how can somebody like you, like me, how do you position your business and your investments in a situation like that where you might have up to a year or a year and a half of uncertainty before prices actually turn the other way?
Sure. I mean, you could go to the beach. I mean, last market cycle, when I looked back at that, if I'd sat on the sideline for 2 years, I'd be better off, probably $10 million better off than I am today, by literally doing nothing. But I was so hell bent on trading real estate that I ended up losing a bunch of money. The other thought is, okay, well, what's the right side of the trade? So wholesaling is a great way to do it. Assigning contracts, just getting in and out of deals, but just making sure you're buying well below today's price, selling right at today's price, and then you can ride the market down by just purely wholesaling. The
Mm-hmm.
other the other way to do it is option contracts, because then you can extend the time to actually buy. But again, if the price is not good, you're tying up an option contract and then you're never going to execute on it. But I've seen all sorts of creative strategies come out this year. In fact, I talked to one operator. They have an option contract that allows them to fix up the property. So they fix it up. And then by the time they close on it, it's at the increased value. So they are able to either cash out with a loan greater than what they paid, or be able to flip it as a profit and collect the difference. I mean, I've seen all sorts of cool strategies coming up, because you can control real estate without having all the risk of owning real estate. So that's one way. The other way
Mm-hmm.
is wholesaling, which I mentioned. And then the other way is you could just sit on the sidelines, which I mentioned at the beginning. I mean, it's a risky market. So definitely long development projects. I mean, I could tell you about a good friend of mine paid 20 million bucks for a mixed retail, commercial, hotel, strip plaza,
Right.
residential in there. Paid 20 million bucks for this land, prime real estate in Orlando. How much do you think that went down when the market crashed?
I don't know. I mean, something painful.
2 million. So it went from 20 million to 2 million. Did he pay 20? He ended up waiting about 2 years because that was such a big bath. He just couldn't fathom.
Yeah.
By the way, that
Yeah.
was all the money he'd made from a large timeshare business in Europe. He ended up selling it finally at 4 million, still a $16 million bath, by starting
Huge.
a development at the end of a cycle. So I would say keep your horizons short. Don't be getting into big rehab projects, small rehab projects, flipping, just really paying attention to the trend in the market. And what I mean by that, if you can look at the active pending and sold and the days on markets, the days on market's high, that means stuff's probably going to trend down because people have to sell.
Mm-hmm.
And then if you look at the actives, if the actives is lower than the pendings, and then you've got then the solds or the pendings they're lower than the solds, that means you got a declining market. So that's why I always look at active pendings and sold,
Yeah.
because actives don't tell you the story and solds don't tell you the story. You want to compare all three. Condos are probably the easiest, because if you got a whole building full of 1,100 square foot condos and you run that active pending sold for the last 3 months,
Mm-hmm.
that can tell you almost everything you need to know, because you just look at which one's higher and then you can tell what way the market there is moving. I mean, you look at a market like Miami. Miami's been showing cracks in the armor for about the last 6 months to a year. I mean, that's what the graphs are showing. So it's really not only important to look at interest rates and look at stuff nationally, but get it down to your market. Every market's different. Even saying Tampa's on fire, that's a misleading statement. Downtown Tampa may be on fire with a rental market, which it is, by the way.
Mm-hmm.
Then you may have the suburbs where the prices are flattening out. And then you may have stuff, residential stuff in the hot zip codes under 500,000 that's hot, but over 500,000 is cool. So anytime someone makes a generalized statement, I have a problem with that, because it doesn't reflect reality. Real estate always moves based on supply and demand, and that changes even within the same zip code. You can have one price point moving and one price point not moving. Right now, locally, I'm seeing under 300,000 moving great, but the luxury markets post-COVID's probably down. When I say post-COVID, we're kind of at the time of this recording into round 2 of this.
Mm-hmm.
And that's down probably about 15%.
Is that
So
right?
funny, you
I've,
mentioned the affordable stuff up 10, and I'm seeing the luxury stuff down 10 or 15.
yeah, my comfort zone has always been, small block single family homes, 130 to $150,000
Yep.
after repair value, and that's where there's naturally the most amount of people that can buy that kind of house, that can rent that
Yep.
kind of house. If you're in a recession, there's still going to be people maybe downsizing into that house. If you're in a boom, there's going to be people moving out of mobile homes and low quality multifamilies into those kinds of houses. So you're always kind of safe as far as cash flow is concerned. And the people that buy those are far less price sensitive than the people buying those $800,000 houses or the $1 million houses. So it's, when you're kind of getting towards the top of a market, that affordable section is a bit safer, and when you've bottomed out and when you're going up, like maybe in 2013, 2014, you can probably go gangbusters in the higher end ones because the margins are going to make more money per property.
Absolutely.
It's not twice as much effort to renovate a $400,000 house than a $200,000 house.
Agreed.
So I remember like back in 2013, 2014, you were going gangbusters doing hundreds and hundreds of deals per year. I mean, what kind of stuff are you doing right now?
What we're doing is two things. We have a seller direct platform where we target distressed sellers in the entire state of Florida. So that's one arm of my business. The other arm of my business is we do wholesale and fix and flip nationally, but our buy box is very narrow. So what we do is we have proprietary software and a proprietary process. We scan all of the online auctions. We look for mispriced assets. And as soon as we find a mispriced asset that for some reason fell through the cracks, we'll buy it anywhere in the country.
Wow. It's buying out of state is a funny one. I mean, on the one hand, a lot of people buy turnkey real estate out of state, which is fine if you have a good team and a good manager. On the other hand, I remember, my business partner David Shaw and I, we renovated a couple of houses in Charlotte from Tampa, and it was not a lot of fun. Worked our ass off, and we were lucky not to lose our shirts. Made about $4,000 on a $300,000 renovation. I mean, it's very, very hard and probably ill-advisable to try and renovate anything in a different state. Do you renovate stuff out of state, or do you advise people just buy in your own market, renovate in your own market, and then when you get bigger and better and smarter, maybe look out of state? How should people approach that local market, out of state market?
Yeah, if you're going to be, well, first of all, if you're getting into real estate, jumping in being a rehabber today is very risky. That's like swimming with the sharks. Competition's high, supply is low, which means margins are going to be razor thin. So I don't think I would recommend that. I mean, what we've transitioned as a real estate education company, we're back to basics. We're just teaching people to wholesale because that's a strategy we feel really good about. We're not teaching people, we're not throwing them in the lion's den where they're going to get their head chopped off. We're teaching them how to get a contract, sell the contract, put money in their bank account, and do that over and over again. And the reason we're promoting that strategy is because it puts the risk on the buyer. And that's really when you have a risky market, you either want to own or finance it or do an option contract, push the risk back to the seller, or assign the contract and push the risk to the buyer. But either way, you don't want to be in a position where you're bearing all the risk. And the person who owns the asset and has the property preservation costs, the insurance costs, the taxes, that's the person bearing all the risk. So it's almost like a hot potato, musical chairs, whatever analogy you want to use. You want to be really careful right now, making sure that you're buying really conservative. So if you are a flipper, you are a rehabber, you want to use a high construction number, you want to use a low comp, and we even discount the comps, especially these $300,000-$400,000 houses, by about 10%. So if we up the rehab, we lower the resale value, and it still passes the test, we'll buy the asset. Otherwise, we're running away from it.
Yeah, I mean, it's very hard to get inventory with that kind of criteria in a competitive market. I mean, I'm not saying you're wrong. Being conservative, I think, is prudent. But let's talk about wholesaling for a minute. You're an expert in wholesaling. You've wholesaled thousands of deals over 15, 16 years. Talk to us a little bit about how wholesaling has changed from the early 2000s to the mid 2000s to today. How are the best people doing it differently than they used to be?
Sure. I mean, the key is to be engaging social media on your dispo. You want to be also there's lots of tools you can use out there. There's white label versions of different softwares out there where you can essentially find out who's bought the property in the last 6 months that's cash, and you chase down all those people. Social media would be one probably big difference. We've done most of the strategies the same, but the big one now is posting in Facebook groups and finding the new buyers. The other trend would be chasing the iBuyers because they pay obnoxious money for properties. I mean, we're wholesaling a property right now. We just put it on the market today. It'll be on the market around 170,000. Retail is only 230, and it needs 60 or 70,000. To me, that's not a deal, but I would be shocked if that house is not under contract by the end of this week.
So you're getting deals from sellers and then reselling them onto the iBuyers? Is that what you mean? Or are you buying them from the iBuyers?
What we're doing is the disposition. The disposition, you got to have, before we would just take down the asset and put on the MLS.
Right.
Now we're going a step further. We're advertising on social media, in real estate investment groups. We're making sure to use software to scrape all of the local buyers around that asset so we can directly market to them. So we have a much more dedicated approach to wholesaling than we did before, because in the upward market, we just throw on the MLS for 10% more than our wholesale buyer might pay for it, and we would get that price typically. But now, you've got to go hunt. You got to go hunt down your seller. You got to go hunt down your buyer, especially for wholesale, because there's a lot of competition on the dispo side of wholesale. Now in retail, the supply is very low. So if you put a nice property in the MLS, that's probably all you need to do.
What about the acquisition side? Where, how did people get 100 deals a year 10 years ago, and how are people getting 100 or 200 deals a year now? How do you find them?
The strategy was the same. You chase distressed sellers. 10 years ago, it was the bank. Now it's the seller, because the prices are high. So there's lots of equity. So we're chasing homeowners today. But as soon as it flips around, like we talked about earlier, and the banks control the inventory, we're back to the banks again.
Back to the banks again.
It's the same game.
Yeah.
Last cycle, 05, 06, I was chasing homeowners. Then stuff come to the auction, got my butt kicked in 2007, 2008, went back to wholesaling, was buying for the banks. It's the same thing. We're chasing the homeowners here at the end of the cycle because equity is high. And here's what happens at the end of the cycle. As prices go down and people go into foreclosure, the fees rise quickly. So what they owe actually goes up. People don't realize that when you stop paying your mortgage, it doesn't stay at 150. It goes 155, 160, 175. So if you got prices coming down and what you owe going up, that's when all the homeowners become upside down. And now the banks control the inventory, and they control in three ways. You can buy it before the sale, but the bank has to approve the short sale. So in that case, the bank controls the sale. You can buy it at the auction if they discount it, or you can buy it after the auction. But any way you look at it, when regular homeowners upside down, the banks control the inventory.
Yeah. No, it's amazing to think that we could be right back where we were 10 years ago in the next year or so.
It's the circle of life.
Yeah, I know. Listen, one place a lot of people fall down when they're getting into real estate, particularly newbies, is they're not very good at underwriting deals. They underwrite something that they think is a $30,000 profit, and it ends up being a $5,000 loss. I mean, can you talk us through a little bit what skills and systems you need to identify what makes a deal a good deal and what makes it, not worth pursuing?
Sure. Well, if you're rehabbing, you got to take on multiple skills. You got to be a general contractor, a project manager, an estimator, and an interior designer. I mean, that's literally all the skill sets you need, and a good accountant. And there's probably more I'm leaving out, but that's just a handful off the top of my head of skills you need to get good at if you're going to rehab a house. So to answer your point, most people starting out are not going to be good at all those things, and they fall down for one or more of those reasons. And typically, they go over budget, they rehab it wrong, it goes too long, or some combination of that stuff, or the contractor rips them off because they don't know how to manage contractors. So rehabbing is really, that's a tough spot to be. That's probably the biggest place where people lose money, and they lose money by overvaluing their rehab. The comps show 200, I can get 250. No, the appraiser has to appraise this. So this is not a market where you want to try to beat the market. To me, that's gravy. If we believe we'll sell it at 200 and we sell at 220, the 220 is gravy, but we're not underwriting it, paying a price where we have to sell it at 220.
Yeah.
And that's another mistake that people make. They fall in love with their rehabs. They don't realize that areas have a ceiling. They don't realize the stuff has to appraise out. And this is a classic case where the market might pay you 220, but the lender will only lend on 200 because of the appraisal. So we have to, unless you're selling to a cash buyer, market demand is great, but the appraisal is very, very important. And it's tough to have something appraised, even when you fix it up, for way more than the highest sold comp. And I would say that's another mistake, besides rehabbing and all the mistakes that come along with that. Just overestimating the resale value is a big mistake that people make.
It is. And just a final word of warning to would-be rehabbers is sometimes they just think it's a cosmetic rehab, but they don't realize that a 95-year-old house isn't the same as a 45-year-old house. And then they get stuck with a bunch of plumbing and electrical and structural bills, which completely
Sure.
ruin them.
Yeah, we talk about budgets, and I split the budgets into have to items and the would like to items. The have to items, if you're going to sell to a finance buyer, or your roof, your
Hmm.
plumbing, your electrical, your AC, and your structural. You have to get those things right. If you don't get those things right, you can't even deal with the cosmetics. So a lot of times, to your point, people say, well, $30,000 is my rehab budget. Does it need a roof? Yes. Okay, now your rehab budget's 20. Okay, does it need plumbing? Yeah, actually it needs, it's all galvanized, it needs to be replumbed. Okay, now your budgets will say 12 or 13. Does it need electrical? Yeah, well, it's got outdated wiring. So now you're down to $3,000. So your $30,000 budget became, oh, by the way, it needs AC. So now you got a negative $2,000 budget. On what we've found on a full rehab is that half of our budget goes on have to items because people in foreclosure are not putting in a new air conditioning unit, or they're
Nope.
not putting a brand new roof while they're getting foreclosed on.
No, they're putting
So all
tarp on
those,
it.
right, all those big ticket items are typically at the end of their useful life. So that $30,000 budget for us, by the way, this is not a huge rehab these days. It's $60,000. That's what we're spending on a home. By the time we do the have to items, and then we deal with the cosmetic items like the kitchen or redoing the bathroom or new flooring, new lights.
Hmm.
And so that's why we try to buy at a higher price point, because to your point, if you're selling in that 130, 150 range, you're putting 50, 60 grand in a house, you got to be buying the house for 50. So you got to be buying 30 cents on the dollar to actually turn a profit on a home like that. So I would say a lot of people don't quite understand the holding costs. They don't understand the lender, the taxes, the insurance, the property preservation. You got to mow the yard. You got to keep up with the property during ownership.
Hmm.
And they just look at HGTV, which says you buy for 100, you put in 50, you sold it for 200, and you made 50. You and I know the agent's got to get paid, the selling agent, the closing costs, the holding costs. And out of that 50,000, you may net 10, $15,000 with that scenario I gave you, where you bought for 100, you put 50,000 into it, you sold it for 200. You're not
Yeah.
making $50,000.
And look, there's no need to throw in the towel if you made $2,000 on a property you thought you were going to make 30,000 on. You probably learned a lot that you can use for the next
Absolutely.
10 flips and the next 10 after that. But
For sure.
listen, moving on, I think the next couple of years are going to be very useful to anybody that has the luck to be involved with a mentor. I mean, I think they can be very beneficial to people in life and in business. And many of the successful people I've spoken to have had one. Was that the case for you? And did you they play a big part in your success?
Absolutely. After the first market cycle where I lost my shirt, I picked up two mentors. One was the first person who lent me hard money, and the other person was the person who lent me the most amount of money over the years. And so the lenders in my life became my mentors. They both lent me between tens of millions and in one case over 100 million. And I listened to those guys because now their net worth in one case is many tens of millions, and the other case is over 100 million. So I listen to people smarter than me, just like I'm getting a trainer at the gym. I want someone who's in better shape than me.
Hmm.
Same way in business. So a mentor not only will show you what to do, which is cool, because of their experience, they'll show you what not to do. And there's
Yeah.
probably just as much value, if not more value, because if you think about the money game, it's making money. Next stage is keeping the money, which is where
Yeah.
a lot of people screw up. They get the first stage down. They have a business that generates a bunch of money, but then they don't keep it. And then the third stage is keeping the government away from it. And when you really understand the money game, you realize that tax laws were designed by rich people to protect rich people,
Mm.
which means if you pay attention to rich people, they know how to use the already written laws in an advantageous way to minimize tax exposure. So that's probably my overarching
No, I
lesson
think
on
that's
mentors.
fantastic. So is there, I mean, there's no silver bullet, but what advice do you have with someone, whether they've done 5 deals or 100 deals, if they wanted to find those special one or two mentors, what way do you go? Because they're not just, going to turn up at your doorstep and they're not going to give
Sure.
you lots of
I mean,
time
you
for
got to
free.
seek out the mentor, figure out how to provide value. In my case, it was borrowing money from them. By
Right.
putting money in their pocket, I was able to get their advice because now I was a use to them.
Hmm.
But just coming up and asking someone if you can pick their brain or take them out for coffee, I mean, I don't want a cup of coffee for an hour of my time.
No.
That's just not of interest to me. I want to see, okay, well, what can you bring to the table? How can we do business? And then in my case, bring me properties, so I'm a property investor. If you could bring me a discounted deal, we can make money together. That's a way for us to engage doing business. And it's the same way as me borrowing money from the hard money lender, right? They
Yep.
lend money. That's how they make money. I started to make the money. Now I become a little bit more important. So I think that having a value driven mind where you're looking at how to actually add value, I think that those questions are a little disingenuous. Well, how can I help you? Because it's such a general question. Try to
Yep.
understand what the business they're in, and then use some common sense and try to figure out, based on their business, what you can bring to the table to add value. And yeah, so I'm a mentor also, someone who's gone where you want to go.
Yeah.
I've been through a market cycle. So if you want to know how to go through a market cycle, do you want a mentor who has not been through a market cycle and been buying properties for the last 3 or 4 years and is a self-proclaimed guru? Or do you want someone who's actually been through a market cycle? So I think that right now, my experience and people like me who've been through a market cycle, although we may not be the coolest kid on the block on Instagram of the last 2 or 3 years, people are going to look to our experience because the guru that's just popped up lately can't navigate you through waters they've never been through.
Yep.
Nor can I speak intelligently on commercial. So I don't try to do that. I haven't bought thousands of doors. But I know prices are high. So I'm not interested in buying thousands of doors. There's no free lunch in real estate, whether it's self-storage, commercial, single family, whether it's an A property or D property. Everything's priced according to supply and demand, and investors use the substitution principle. Risk is higher, yields are higher, and so prices are lower. And that's across the board in real estate. And even outside of real estate, it's with gold as risk adjusted for gold, for cryptocurrency, for the stock market, for each equity within the stock market. Everything has a price for a reason. And so I always laugh when people think they found some magic bullet that no one else has discovered. I'm like, there's not really. Everything's priced according to the substitution principle, where investors can move those resources into whatever is going to make the best yield. And that means that if there is an opportunity today, typically it's closed pretty quick because the money will flood there pretty quick.
Yeah, I think it. Listen, last question, Lee, because I know you're a super busy guy, and I don't ask this of every guest, but I'm going to ask it of you, and it's about time management. Because I remember the first time I went into your office and I saw you had these 6 monitors on your big desk, and you explained it to me for a few minutes, and literally the next day I ordered an extra 2 screens, so now I have 3 screens with me at all times, and it just improved my time management and my productivity dramatically. Like hugely. But what tools do you use to leverage your time to accomplish more in a working day than most people? Have you learned any old school tricks you can teach us? Anything new you've learned in the last year that you can share?
I think allowing your calendar to really rule your day, that to me is important, and color coding your calendar. So if it's time and place specific, I use one color. If it's just got to get done during that day. Another tip, I hate notifications. Notifications like a text message. If you text me and I click on it, the message is read. I forget about it. If a notification pops up and you click it off, it's gone. So I have all of my reminders emailed to me. That way then it sets up a queue for tasks. And so I like doing stuff like that. I don't like text. I don't like doing important business through text or with just a pop-up. So I try to avoid that. I try to have my incoming tasks come through my email. And that way, then I can just work my way through my emails and get everything done. So I think that's super important. To-do list has actually become less important. And I've had my assistant manage my to-do list. So I used to manage that myself. I just really have my calendar drive my day now. That's the primary tool that I use. And planning is key. If you jump in and figure out your week Monday morning, you're going to waste most of Monday figuring out your week. If you got your week planned out, I found taking an hour or so on Sunday is good, because that way then I hit the ground running on Monday. That would be another technique. I think really identifying the non-negotiables for the day. It's probably going to be 3, 4, 5 items. That's it. I mean, if you say, I need to get this done today, there's no point having a list of 50 items.
Right.
But if you can say, what are the 3, 4, 5 things that are going to swing the needle today? And not only for the day, for the week. So you can get that feeling of accomplishment at the end of the week. That means anything is not that just gets pushed to the side, and that's okay, because if you accomplish those 5 things, they need to be revenue generating activities too, not busy work.
Yeah. Okay, that's fantastic. I'm totally with you on that. Well, listen, any final thoughts, Lee, on how people can get in touch with you? Anything you want to tell our listeners about before we say goodbye for the day? Yeah, absolutely. If you want to learn about our real estate educational platform, it's realadvisors.com. If you want to connect with me personally, it's Real Lee Kearney on IG. And you can connect with me either one of those ways. And just make sure you're
focused. That's what my biggest advice is, just focus. Don't try to do 20 different things. Don't chase shiny objects. Focus on one strategy and make sure you dial it in. If you've never done real estate, I'd highly recommend you start wholesaling. We teach that. But more importantly, it's the most risk-free strategy in real estate. It's like doing real estate with training wheels on. You get to get in and get out of a deal, collect the money without having to bear all of the risk of owning real estate. And that's why, to me, it's the best strategy. So if prices are going up, prices are flat, prices are going down, you always get paid. And that's really why I like wholesaling. It's a timeless strategy. And it'll also put cash in your bank account for the next cycle when prices do come down. Then you can actually use that to start buying rentals, which makes a lot of sense at the bottom.
Good advice. Good advice. I really appreciate it, Lee. I really appreciate your time. I'll let you get back to your day. It was great chatting to you.
Yeah, thanks, Colin.
There you go, guys. That was show number 6 with Lee Kearney. I hope you enjoyed it. I thought that was really good. There's a lot of words of wisdom there from Lee. He is an incredibly experienced and incredibly successful investor who's traded through a couple of different cycles, and he is definitely worth listening to. And in case you're wondering, Lee is also from Ireland. He moved here originally in 1996, and he does live in Tampa, Florida as well. So we have that in common. And yeah, it just goes to show it's worth getting different points of view. You know, Lee is quite bearish on where this market's going. You know, late this year, early next year, he thinks prices are going to fall, evictions and foreclosures are going to go up. Let's see how that pans out. We're in a strange time at the minute, and I think education and networking is more important than ever. And I'm trying to do my little bit of that with this show. And like I mentioned at the top of the show, I have a new website, colininvestments.com, where you'll find a lot of tools and useful information to help you on your real estate journey. And do by all means find me on Facebook and Twitter, Colin Investments, or on YouTube and Instagram at Colin G. Murphy. And look, if you're enjoying this show, please do take a moment to give me a quick review or rating, or by all means share it with friends and family you think it might be of interest. And I will be in touch soon with show number 7. But until then, you guys keep learning, keep networking, and stay connected. This is Colin G. Murphy signing out. Bye-bye.